Hello, everyone. Welcome to today's third Hubraum on Air digital event. My name is Leonard. I will be moderating today's talk, and I'm very excited to be here on stage again. Today, I am joined with very interesting panelists here on stage. I have Florian Steger sitting right next to me. Today is actually a very special event because we are teaming up with Shenzhen-based HAX Accelerator HAX, and they bring a very interesting candidate to the stage, the managing director, Duncan to be precise, who will introduce himself in just a minute. And we're also bringing an industrial venture technology fund to the stage, also remotely joining from Munich. His name is Robert Gallenberger. We additionally have Stefan Noller from Ubirch, the CEO, and last but not least, Florian and me here on stage. So just for you, for the audience, again, thanks for joining. We're looking forward to a very interesting discussion. And for a quick run-up of what's happening today, we'll have a 30-minute general discussion where we get into the topic of securing venture capital for deep tech startups in Europe. And then coming up, all of you can raise any concerns, any questions you have to the panelists in a 15-minute Q&A session, which will round up our 45-minute to 1-hour discussion. Yeah, so I'm happy to have you. I'm happy to have the panelists, and let's get into the discussion and quickly have a little round of introduction. So why don't you start, Florian?
Sure, thanks, Leo, and hi, everybody. My name is Florian Steger. I'm the investment director here of the Hubraum Fund. So I guess you all know Hubraum. Hubraum is the incubator of Deutsche Telekom, and one of the activities we are having is actually that we have an early stage and seed venture capital fund where we invest into startups that might be interested into becoming partners of Deutsche Telekom in the future. And in this capacity, I'm really happy today to answer your, Leo's, questions and also the questions from the audience.
Thank you, Florian. Let's have our panelists from all over the world join. Let's have Duncan sitting in Hong Kong, and Robert from Munich, and Stefan. Welcome, everyone. You're all live. We can see you well, and you look all happy with a smiling face. Thanks for that. Why don't Duncan, why don't you have a go and tell us about yourself?
Sure. Thanks for having me. So yeah, my name's Duncan. I am general partner at SOSV, which is a global fund specializing in life sciences and hardware. And I'm also managing director of HAX, which is the accelerator program, which is normally the first kind of touch space that we have with startups. I specifically invest in hardware. So we look at a wide range of different companies across many verticals, mostly industrial focused. So it's about 70% of what we do. 20% is in healthcare, and then just a small amount, around 5% into consumer. We're normally the first institutional money into companies. We then bring experience with a program, kind of full stack design engineering expertise here in Shenzhen, or across the border from Shenzhen now. And then we have about 75% of our fund goes into follow-on investments into the companies that we've backed through the accelerator program.
Wow, that sounds very promising, very interesting. Thanks for joining in, Duncan. Thanks for the introduction. Let's move over to Stefan. Stefan Noller, CEO of Ubirch, here also in the round. Stefan, please give us a little insight on who you are and your background.
Yes, sure. Thanks for having me. So yeah, I'm CEO and founder of Ubirch, but I'm also I'm a serial entrepreneur. So this is my fifth startup at the moment. Two of the others that are in startup mode yet are hardware startups. So a microbit competitor, Calliope Mini, educational tool, and one of the most successful femtech startups in Germany. But my main focus is Ubirch, which is blockchain and IoT combination. So we're using blockchain technology to secure data from IoT devices, and we got rid of hardware in that. But maybe we'll touch on that later.
Okay, Thank you very much, also to you, Stefan. And now moving over to our fourth guest here, just confirmed 2 days ago, so we might as well call him special guest, located in Munich and being a partner at btov, Industrial Technology Fund, amongst many things. His name is Robert Gallenberger. So Robert, thanks for also joining this discussion. Introduce yourself as well, please, to the round.
Thanks for having me. Yeah, I'm Robert, a partner at btov. We're an early stage venture firm in the market around 20 years. We started in Switzerland, operate offices today in Switzerland, but also in Munich, in Berlin, and in Luxembourg. Manage around 500 million assets under management. In different investment categories, we have a private investor network. This is how we started 20 years ago. More than 250 private individuals with a lot of know-how and capital and experiences in building companies continuously invest together with us. And we operate 2 fund strategies, one of them being the Industrial Technologies Fund. That's a 100 million fund we set up in 2018, investing all across the industrial value chain, both in hardware and software, oftentimes a combination of both. And transversal technologies like quantum computing, photonics, electronics, etc. We invest in the early stages. Sweet spot is usually somewhere between seed and Series A. Ticket sizes between 1 and 3 million euros out of this industrial tech fund, with a lot of reserves. We've learned it the hard way to keep those reserves, so we can go up to 10 million in total per company over several funding rounds. I'm one of the partners responsible for the Industrial Tech Fund, mechanical engineer by training, started in the automotive industry, 4 years on the shop floor, and 14 years ago or so stumbled across venture capital through my MBA studies.
Okay, that also sounds like a very good and promising candidate for a discussion. And yeah, after hearing your introductions, I think we can see there's many millions of dollars or euros here in the round that are being managed by Hubraum, HAX, btov. And we also have different focuses and some similarities. There's software, there's hardware. And maybe this is one really interesting point for a discussion that we could start up on, talking to Duncan, for example, Managing Director at HAX. Duncan, tell us, what are some of the differences that you see, that you've learned over the years with experience that show a difference between a software or a hardware investment?
Yeah, so I say hardware. It's interesting. Robert made a very good point. Actually, almost everything that we do well, exclusively, pretty much everything that we do has a software and a hardware element. So for many of the investments, when we describe it as a hardware company, it's more a company that has software and hardware integrated. And I think, if I think back like 5-6 years ago, there was a lot of resistance in the investment scene around hardware. Prior to connectivity, a lot of people have found that a very difficult place to invest. You don't get the kind of network effects that you get with software, and also it's slower. That's definitely changed. Now investors are starting to see software and hardware companies as kind of some similarities, but also some unique strengths and weaknesses within those. So within hardware, the biggest challenge is it takes a lot longer to get to what you'd consider as the metrics for a seed round than it does for software. The ability to iterate quickly with customers, the ability to get the product out to multiple customers in a short period of time is dramatically reduced with hardware. That said, when you've got a piece of hardware, you've got a really nice moat around you. You've got the ability to kind of secure the customer relationship and continue to build on something which is probably very unique in terms of its data set, or it's performing a physical service, which is difficult for software to compete with.
Okay, that sounds reasonable and very interesting. Maybe to get another opinion, another view, Robert, you managing and this industrial tech fund of btov, What's your opinion? What's your intake on this question of a difference between hardware and a software investment approach?
I guess I very much agree with what Duncan already said. Adding to that, once you have a product which is ready to be shipped, and you're in the hardware world, you're facing a different risk profile when shipping larger quantities of your product compared to software if you discover a problem in your product. Right. So shipping out physical goods obviously takes time and money. Bringing them back or sending out people to fix the product out there may cost even more than that. So I think there is a different risk profile compared to software, which in many cases can just be updated by sending out a patch over the air or over the communication networks. And in general, we see a completely different profile in the B2V portfolio, where we have a lot of software companies, especially with our digital tech fund. They tend to need really large quantities once they get into big scaling mode, and then you see these 50, 100 million round sizes happening. While I would say hardware is more front-loaded. You need large amounts of capital to have your first MVP, and then you get the product stable. But if you have a smart working capital model, you might not need these very large rounds, Series C and onwards. So I think it's not only a comparison of the absolute amounts of capital needed, but when in time of your company development you need those amounts.
Yeah, really agree with that. It's a very important point, right? And you can see that throughout a number of different growth stage companies in hardware versus software, that hardware does actually provide some unique advantages that software otherwise doesn't have.
So maybe even in more obvious terms, it's, in my opinion, not true that software by definition is more capital efficient. I think it's more capital efficient in the early stages.
Yeah, yeah, totally.
Maybe here I could also ask Stefan to join this question, as he's told us he's a serial entrepreneur, having founded by now 5 companies. Both in the software and hardware space, but then Stefan told us he dropped hardware after some time. So Stefan, what's your take? What have you experienced in also from the startup perspective in seeking capital and trying to raise these first rounds? What was different with software and hardware?
Yeah. I mean, first of all, I can second, what the 2 colleagues did say. So there is definitely a place for hardware, So at least, I mean, we ourselves are some kind of hardware, and we're living in a world with physical assets. So at the end of the day, it comes down to, if you contribute to people's lives, it will often be hardware, right? Because that's how we live. On the other hand, I very much believe in this, quote of software eating the world. So I think, so one of the things in Ubirch, we brought out with G&D is a blockchain client on a SIM card, and you could say a SIM card is a piece of hardware, but it's also vanishing, So SIM cards are getting smaller and smaller, and now there are the first concepts of completely software-based SIM cards. So this is also a trend, you should be aware of, that there is still, I would say, a big shift towards software and what we call the digital layer. So that's one take. The other one that I would like to share, I had this funny experience, when we did a funding round for Ubirch in the earlier stage. We had a piece of hardware, we were super proud of it, like a little relay board, credit card sized, nicely designed, 4th iteration. And then I had this investor call, and I pitched, and he liked it, what we did. And then I showed, the board into the camera, and he said, "Is that yours?" And I was like, "Yes, sure. I mean, it's super awesome technology." And he said, "Okay, then the call is over. We don't invest in companies that do hardware, right?" and it was not just a single occasion, you know. So that's really, I mean, something I think where we should be honest, you know, for entrepreneurs and startups. It's definitely, I mean, I love to hear, you know, from the colleagues that the ambition is rising, you know, on the investor side to invest in hardware startups. But I would still say it's hard, right? It is more capital intense, you know, in the beginning. Couldn't agree more. And try to raise a lot of capital in the beginning of a company in Europe. I mean, it's even difficult for software startups. This is really something that doesn't make your life easier, you know, if you do hardware.
All right. Thanks all of you for giving your first thoughts and opinions to that question. I want to move on and actually skip to sort of the today, everyday life situation that we've now known for, let's say, at least half of a year. Looking at the current state, the pandemic that we still face, I want to ask Florian, sitting next to me, what sort of changes have you seen happen now in the state of pandemic, and what are some consequences startups are facing, and what in the end are also offers that maybe you from Hubraum or other accelerators like HAX or institutional funds can give to these startups in hard times?
Well, interestingly enough, there hasn't been so much change, to be honest, at least from a financing and fundraising perspective. And to be honest, I was really surprised about this. I mean, if you look back at kind of like previous crises, let's say in 2007, like the financial crisis, or even like in 2000 with the new economy bubble bursting and this kind of stuff, that always had immediate huge effect on the funding landscape for startups. What I see now, that there was maybe kind of like a short break in March, April, where everyone was like reorientating and thinking about how this will work out. But now I don't see any decrease in like investment activities, both in numbers and size, and also not in valuation. So this has been like at least stable and maybe even on the rise for really good startups in the past few months. So, I mean, I think there is still, even if we are talking here about seed and early stage investing, I think there is still a huge correlation of the financing world for startups and the stock market. And I think that has also been the difference, that in the previous crises, you always had this big downturn in the stock markets. Now you don't have it, right? Let's see how the next weeks work out. But so far this year, it was also the stock markets were pretty stable. And if you look at the big picture, when it comes to capital allocation, who puts money into the funds, that plays a big role, right? So I think as long as the stock markets are stable, I don't think there will be a special crisis in terms of fundraising. When it comes to special offers, I think there is no need right now for special offers from, let's say, the private capital side, because we are basically doing business as usual. There are obviously a lot of opportunities right now when it comes to like government funding, subsidies, special funds are being set up by state banks, for example, here in Germany, like the IBB in Berlin, or I know Ubirch is working with the NRW bank, where those Landesbanks in Germany have set up special funds to invest even more in that times of the crisis. So I think that's a huge opportunity that every startup should like evaluate and see how they can make use of this short term. I think when you ask about maybe the consequences inside the startups, definitely it was, I mean, depending on your business model, right? I mean, obviously we had startups really profiting from the current situation, and they will profit in the future even more, both in B2B and in B2C. But startups, I think, have a huge opportunity because they are much quicker to change their models, which are like pilot models like anyway, and not fully rolled out when it comes to how to access your market, how to talk to your customers, how to do support, right? So I think this actually accelerates those like developments, and gives huge opportunities in comparison to the incumbent industries and companies who will have a really hard time adapting to that new situation.
Yeah. All right. this is an interesting take, because I think a lot of people who maybe are not, let's say, this much into the space might see the pandemic as a real much changing factor for the worse. But you are actually saying the different, that business runs as usual in startup investing, and that you are actually yes, lots of startups also can raise from the occasion and use this as an opportunity. Also seeing or speaking to HAX in the past, and talking to Garrett and Duncan, I saw that actually HAX was one of the most active VCs in the Q2 of 2020. Duncan, tell us a bit about this. Can you sort of agree with Florian on actually running business as usual or even accelerating investments here?
Yeah, totally. There's actually a lot that Florian just said there that was very interesting, and I agree with all of it. And I want to pick some of that apart. But yeah, we were, to our surprise, it was actually SOSV, so that's the whole of us. So we run like 5 programs: IndieBio, HAX, China Accelerator, MOX, and FoodX. So the combination of those all were the most active seed stage investors in Q2 and Q3, which was a surprise to us. Yeah, I mean, it's, I just want to agree with the first point. Like when we first realized this was not a flu and this was a very serious pandemic, naturally we were concerned. We thought there'd be a downturn in fundraising. That didn't happen. Our teams raised more out in the market than they ever have done in the second quarter. There is that interesting correlation with the stock market. I do believe that's true. I think to add to that, if you look at some of the successes in the stock market, like the FANG stocks or the NASDAQ, that's technology. And people are driven through this pandemic towards technology investments. They see that as a safe haven. And I think there's a trickle down effect into a lot of technology startups, which is a positive. Then the third point is, obviously not all technology startups are doing well. And we certainly saw this with our portfolio. There were certain companies that did really well. Anyone that was looking at, obviously, COVID testing, they did fantastically well. We've got a company called OpenTrons that has a lab automation technology that we're doing now 400,000 tests a day for COVID. We had our fastest ever program to Series A. A company came through our program within 4 months, raised $15 million Series A, doing sanitization using UV, a company called R0. And anyone broadly in the digital health spectrum, particularly those that are looking at remote rehabilitation, did very well from this. And also anyone in just generally in the automation space for industry will do exceptionally well, because what we're seeing, I think, is trends that were already happening just being accelerated by COVID. It's a classic saying, right? Some of the best companies in the world get born out of times of crisis. And I think we're just starting to see some of that happen now.
And also addressing now maybe Robert and including him to this question. Robert, can you also add to this maybe, and tell us about your experiences from the last months? Has it been any different to what Florian and Duncan are telling us?
I think broadly speaking, we saw the same macro trends, the same challenges and opportunities. I think if you boil down to a single startup, the world has become more volatile. So it made a difference if you went out mid-March to fundraise and all the borders were suddenly closed. And if for whatever reason you were trying to reach international investors, particularly from the US, it was just not possible to meet each other. And while by now a lot of funds have sort of officially said they're able to do remote deals and it's all good, well, what I saw in a particular example was nobody knew how to do that early April. And let's see what now November brings. If Europe is closing down the borders again, let's see which of the larger follow-on rounds will really be done fully remotely. So I think they're really good examples that large rounds happen without any hesitation and a huge valuation, and all is good. But we have seen the opposite examples as well.
Yeah. And you already touched upon the point of borders, and maybe I can use this to jump actually to another very interesting question that I want to raise here. As we see, we have Duncan sitting in Hong Kong with another time zone, and us here located in Europe, all spread across Germany, I guess. But also HAX and SOSV operating in the US. What are some, Duncan, maybe towards you, what are some of the differences that you could see when it comes to venture capital and investments in Europe particularly, and then in combination or in comparison to the US or China? What makes Europe a special thing? Is there something like a special factor about Europe?
Yeah, I mean, like I actually find it difficult to clump Europe as one area. I feel like honestly the investment scene in Germany for us is definitely the best, the most relevant. I.e. that Germany has a history of very powerful industrial country, and therefore industrial tech and hardware, very similar to what you see in Japan, which is another area that we're active in. Actually, there's no resistance towards hardware that might be seen in other countries, right? So, in particular, Germany has a kind of a great underlying technological understanding of the importance of hardware. And so that's been very good for some of our teams. That said, those are German teams. I think in America, obviously, again, it's a big area. California is the epicenter, as we know, the Valley, and the majority of all deals, including hardware deals, get done in Silicon Valley. There you find that, I would say an interesting trend is that, which I haven't seen so much in Europe, but I'd love to hear from the other panelists on this one, is that the hardware companies tend to get matched to software companies in terms of their metrics for success. So they'll typically look at recurring revenue at a 500K mark, 500K ARR as a good metric for achieving a seed round. That's kind of a universal metric that I've seen, and I haven't seen that so publicly voiced in Europe. China then is a completely different situation. China has changed a lot. You will have heard in the past that China had a huge amount of venture capital available. That's no longer the case. It was drastically cut back around 2.5 to 3 years ago, which has actually been beneficial for the ecosystem. Honestly, there was a little bit too much money at the time. And so now there's been a large focus on quality. One of the differences I would say in China is, again, very accepting of hardware. The round sizes and dynamics tend to be quite different. In Europe and the US, typically you're looking at 20 to 25% dilution per round. In China, that's normally 10 to 15%. The investment process, though, for all of those different areas actually is remarkably similar, the deep due diligence process that all of those investors go through.
All right, Duncan, you touched upon the point that you see a lot of the times, and you're interested to hear our other panelists' opinion on this, that metrics are sort of the metrics of hardware and software startups are being compared and matched. This would be very interesting also to maybe address to Robert. Robert, what do you see? Do you see this point as relevant and as true? And also, what sort of features or characteristics need deep tech startups bring to the table in order to perform very well in seeking investment in Europe?
Well, I can start with our opinion that obviously it shouldn't be the same metrics, right? So to us, it doesn't make any sense to have the same metrics for a traditional enterprise software startup compared to an industrial hardware startup. And it can go in all directions, right? We see hardware startups at a very early stage who have large NRE contracts with very famous automotive companies or electronics companies. So what does that tell you? Is that commercial traction that can be a relative large amount of early revenue? But is that a commercial product traction? Not necessarily. So we don't apply the same metrics. To the question, what does the rest of the market do? I think we see enough peers in Europe who have been investing in industrial use cases, in hardware, in deep tech, whatever you call it, for long enough to understand those differences. Obviously, we also target some of the larger Anglo-Saxon funds who, I would agree, tend to make less of a difference. And no matter what you are, what your product is, how your business model works, ask about the MRR. Getting harder sometimes to get them convinced for an early follow-on round in an industrial hardware startup.
Most definitely. And now also here to the left, Florian, maybe your input on this. Where do you see, is this being compared and also maybe adding up? What do you see as also like a make or break metric that startups need to bring in order to perform well, both in hardware or in software, whichever?
Well, I'm not so sure if this is really a question about metrics. I mean, metrics, in my personal opinion, yes, on a really high level, you can try to compare companies, but in essence, if you want to manage or steer a company or also get down to the level of really making an investment decision and having a strategy for this, I think there are like individual metrics for each individual company and startups that you need to find and define, which is actually really, really difficult, right? And a huge part of the work a startup founder has to do, also together with his or her investors. I think it's more about the strategy, actually, that I think there is no different set of strategies, overall strategies for a hardware startup. Maybe there is not a hardware startup per se anymore, right? Because I think just someone who produces a piece of hardware and wants to sell it one time to maybe even a one-time customer, that's not a really attractive business anymore. So like Stefan said before, software is eating the world. Maybe also when it comes to the business strategy, that you're looking for repeatable revenues, right? And saying, how can I really make the most of a customer lifetime? If you look at how you can actually upgrade your business model, like in software, where you say you have an like initial sale, which might be relatively low when it comes to your profit, but then you have upselling opportunities that are attached to your hardware. When it comes to like creating a barrier of entry, right, for your competitors. I think these are all concepts from the software world now being transferred. And I think the most successful hardware startups always have this combination between hardware and software and are using strategies from the software world. And if you look at the big guys, I mean, if you look at a hardware business of Amazon, for example, right? If you look at the Echo line of the like intelligent speakers, I mean, is this really a hardware business? Yes, they're using the hardware. But in essence, I don't think the big strategy behind it and the big profit maker will be to sell pieces of equipment. It's a whole embedded strategy into having an entry point for just the marketplace of Amazon, building a marketplace for services that are running over this hardware infrastructure. So I think it becomes much more complex, but also much more interesting. And then again, you need to find the individual metrics, but that's really should be done company by company.
Yeah.
Leo, can I add something to that?
Please, always.
Yeah, because I like this thought very much, from Florian, and the thing that I would like to add, as we're in the industrial space too, is that even the strongest hardware manufacturers, like take a company like Zeiss or that are doing these big machines and so on, are moving into software, in terms of their business model. So hardware as a service, machine as a service, all these kind of things effectively mean, that even those big machines will not be sold as hardware anymore in the future, but they will be a service, right? And if you look at those hardware startups, many of them are trying to push this trend, to make machines, put them on the internet basically, or get data out of them for invoicing and so on, in order to offer them as a service. And I think one interesting consequence out of that is that at the end, it's indeed, software is eating the world, and even a hardware startup needs to understand the mechanics of digital business models, of software basically, right? Which is, because that's the mega trend, Tesla is one of the. It's not a beautiful hardware, right? But it's very well thought through from the software end, right? And the German car manufacturers are failing on the software side. They're brilliant in creating hardware. And that's an interesting thing, and I would also like to hear from the investment colleagues here on the panel, because I think if that's true, there is no hardware business anymore. That's how I would put it. We are facing a mega trend into digital business models, or you could say software-based business models, and hardware is just a leveraging that, or a layer that produces data in a sense.
Yeah.
Can I give you the twist? So first, one side note. I think software has not invented recurring revenues, right? Just to get that right. I think the razor blade model was a hardware-based model and led to very attractive recurring revenues, and that was never invented by the software world. I think we somehow moved over the last 20 years into a investment mindset, which was software businesses are the more attractive business models. I think we should give it a new spin and say it's the duty of a founder and a successful CEO to find the most attractive business model, no matter if that is linked to hardware, software, or a combination of both. And that would also be my answer to your initial question, Daniel. I think it's not so much thinking about what metrics does what type of investor want. I think we need founders and CEOs who pitch their business in a convincing way. And if you're good enough in pitching a really attractive business case, I think investors will listen. So I know I'm simplifying a bit, but I think that should be the attitude. Instead of always this playing, is this hardware, is this software, do I invest in hardware? I mean, in the end, all these internet investors have invested big time in scooters and shared bike schemes. There was a lot of hardware, right? But they saw an attractive business model. At least they thought so initially.
On the other hand, Robert, if I may challenge that, so because you said initially, that hardware comes with more front load, so you need more, significantly more capital in the beginning. So what I would expect, and I'm talking to investors, every second day, and usually, the conversation goes like, and all this, so we do typically rounds of, 2 to 7 million. Our ticket size is 500 to 3 million, and so on. All these kind of metrics or facts. And I would expect you guys, to do one more question in the beginning and say, okay, are you hardware or software? And in case of hardware, our mechanics are, completely different, So we do ticket sizes that double the size or triple the size in the beginning, because we know you have production costs, you have certification costs, and so on. And that's, to be honest, because I'm running hardware and software startup at the same time, in a sense, so I can really compare. That's not my experience, So except some investors, that really have a very sharp focus and say, we're just hardware maybe. But wouldn't that be the consequence, that you have kind of a routing and say, okay, if you're a hardware startup, there's a completely different set of ticket size, phases, and so on. I mean, wouldn't that be the consequence of what you were saying earlier?
Not exactly. I would, again, rephrase it. I would not make the difference, are you hardware or are you software? I think the question should be, what's your business model? And what's the profile of your capital needs? Have you thought that through and have you optimized that? And if this looks attractive, then I should be interested as an investor, unless my sources of capital have for some reason forbidden to do any hardware. So I should be looking at the business model. I should be judging, is that interesting? then I should understand the capital flows over time, the capital needs over time. And then I need to think, am I the right investor? What can I offer something that makes sense to cover this capital need profile, or who else do I need as a co-investor to cover that properly?
I think that's actually, sorry, Robert. I think that's actually a really good recommendation for the founders who are listening, to really do the due diligence and the research about the investors you are talking to, because I would never recommend, if you have a startup that heavily depends on a piece of hardware, don't go to an investor who has never invested in a hardware business, right? I mean, it sounds obvious, but to be honest, that limits the number of potential investors, at least in Germany or Europe, a lot, right? If you really look at the portfolios and say who has experienced running this from day one, because he knows how to ask the right questions, knows what the financing differences are, but to educate basically an investor on what's necessary to do a hardware investment, I mean, they will all listen, right? Because it's interesting and you learn something, but you will have a really hard time to convince someone. And I mean, it's not out of like a misunderstanding of the model. It's just that I think investors are willing to take risks in areas that they know about, right? And that where they can make an educated judgment. There are still huge risks involved into the market itself, into maybe technology product risks. So you don't want to take an additional risk if you don't have the blueprint in your drawer, basically, about how a hardware startup should work, what the metrics are, and what the risks are.
But Florian, wouldn't you say, I mean, because you touched a big problem, you know, for the European investment space, I would say that there are only a few, I mean, it really, I would say roughly 10% or so of the investors remain on your list, you know, if you apply that filter that you just mentioned, if not less. But shouldn't we have, you know, shouldn't we ask VCs and investors, you know, to learn and embrace hardware a little bit more? Because this is, especially if you also look, you know, at the nature of the European, you know, tech scene and the engineers that we have, shouldn't be hardware like 50% of our focus or so, and not less than 10?
So, I mean, you learn it by doing it, right? You don't learn it like theoretically, right? I mean, you learn it by doing 4, 5, 6 investments into a space, and then like most of them fail, and then you have learned, basically. That's I think, like the learning ship model in the VC space, like in every kind of area. I mean, you are right that I think it shows here we have a huge opportunity on the one side, because we have so much strength and knowledge into hardware and building in Germany and Europe. But those people are not really part of the investors space, right? Or only like to a very small extent. I mean, yes, all the Mittelstand companies and whatever thought about doing investments and maybe tip their toe a little bit into working with startups and doing this. But I think it's still really tough, for example, if you look at the seed stage, right? If you have a pure software business or pure service business, I think you find, even in Germany and Europe, you find these super angels maybe because they had this experience on their own, who are willing to invest significant money, like 6-figure, even 7 figures, in a really early stage in your company, because they know the model. To really find someone from, let's say, the old economy who may have the hardware know-how and everything that's involved in it, but is willing to put this kind of money into a crazy startup company, right? That's still quite rare.
Now I hear silence. Any more?
But Duncan, can I ask, you know, because Shenzhen obviously, you know, is perceived as a completely different space when it comes to that. Would you say it is so? You know, that you know, the hardware-minded, you know, like state is completely different to what you experience from European investors?
Yeah, I mean, in China, a lot of people have made money in manufacturing, right? And so there's recently, so, you know, you talked about the challenge there, Florian, about finding somebody from the old economy, the old industries. Well, that's a new industry here in China. So there's much less hesitation around hardware. Also, people see hardware happening so quickly around them. They're less likely to feel like it's something which is intangible and risky.
Or slow.
Yeah, so I think that's one point. The other point, which was very interesting, came up a little bit earlier in this thread of conversation, was around companies selling a service as a hardware service. I do think that is, like Robert said, originally came from hardware, but it's definitely been reinvigorated recently within hardware because of software. I think it's kind of flipped back and forth, which is a very interesting dynamic. And now you see particularly a lot of robotics companies offering robot as a service. Hardware as a service has become a kind of ubiquitous terminology within the VC sector. And as Robert said, I completely agree with him there. It's all about finding the right business model. And offering this hardware as a service is capital intensive at the start, but you know what, it dramatically reduces your cost of acquisition for customers because they can just try it. They can effectively lease it or try it. And if you're really good and you believe in your hardware, you will have much better churn than what a software company will do. And this is even bled into the consumer sector. So for example, we invest in a company called Noller. I'm actually wearing them at the moment. Noller, they're a headphone company. They do a subscription service for headphones. So you never actually own the headphones. You pay, there's a range of different price bands you can go on, but you pay roughly, 15 euros a month. And you just continually get this awesome pair of headphones. Then after 2 years, they'll upgrade you to the latest set of headphones. That kind of activity dramatically reduces the cost of acquisition for them, and then improves the lifetime value of the customer over a longer period of time in a world which otherwise would be very, very challenging. I mean, consumer electronics is just an incredibly challenging place to invest into and make money. And the kind of move away from just one-time purchases into a kind of better relationship with the customer through regular payments, just like you would do with Spotify or a range of other monthly payments that you're used to making as a younger person, we'll start to see, I think, in hardware throughout the consumer sector.
Which, by the way, Duncan, if I may, increases the burden, of the capital load, because
initially, yes, yeah, that's the bad bit, yeah. But it's nice because you can build up some metrics around it. So, if you can see, you'll be looking at, just like a software company, you'll be looking at churn. Once you get to a certain safety factor with churn, then you can start looking for alternative means of capital, or just going out to investors and saying that we've got a proven business model here, we just now need to scale it with inventory.
Yeah.
I think I want to raise the word again, and I'm very happy actually to have this live discussion, this ongoing discussion here with all the panelists. Thanks for your comments and these insights. And I want to get involved our viewers though. And speaking about metrics, Duncan, you just raised the word. We have received many interesting questions via the streams on LinkedIn and YouTube. And I would like to give sort of the voice now to our audience and address some of these questions to all of you. And then you can jump right back where you were into a very vivid discussion. So the first question that we received via LinkedIn is, deep tech is lengthy, difficult to develop. What traction and metrics should seed stage deep tech startups aim for, where the time and effort to launch can often be much longer? Who wants to give a go?
I'm happy to start with our criteria.
Perfect.
I don't know if that answers the question, because we actually don't have the one metric. We want proof points that there is a market that is large enough, that there is a willingness to pay that is large enough, and that the product can do what it promises. And it's up to the founders, again, I'm playing back the ball to the other side, to give us the right metrics. I mean, it's very different how our individual startups we've invested in have demonstrated those aspects to us.
Yeah.
So there's particularly not the single MRR or whatever else metric. No, it's we need to know a few things to judge the risks and to see the upside, and up to the startup to find the right narrative to make us believe in them.
Yeah, exactly that. Like I would just say that, like, define product market fit and improve it to me. So it's down to you to define the product market fit, like the aspects of product market fit that will convince us that you have it. And that's normally, and the deeper the tech, the further that is from revenue.
True, and that's why
Guys,
I
there's
think
sorry, Florian.
it's really important in the early stages to choose kind of like the battleground on which you want to fight, right? So I think there are, like, you really need to make sure also in your story what you tell to investors. If you are primarily really working on the deep tech part, but if you really make it and make this work and have your IP on this technology or whatever, this can be used in so many different settings and bring such a huge advantage that you will actually find your market and what you really want to do with it later on. And I mean, we did investments like this. If you look at our like website with the portfolio companies, there's one company called Taraki, which we invested 5 years ago, which was basically, I mean, 2 like quantum physics PhD guys with great, not even tech, right? Basically an algorithm where we thought, hey, if this really works, and at that point in time we didn't know that it will work, but it did, fortunately, that if this works, this will have so many different opportunities what you could do with it. We will find that product market fit later. And now they found it. It's mostly like an automotive, and so it's all good. But I think you should make it really clear from the get-go, if you are so deep tech and so concerned about technologies, but then have this huge opportunity later on, that you can focus on the technology part, or that you say, no, I know that kind of like I see a problem in the market space with certain customers that I can solve, but I'm not married actually to the tech problem, right? If I find an easier way how to solve this problem, I can do it with a completely different technology. And I think you should make clear in your communication with investors which kind of like battleground you are actually fighting on.
Mm-hmm.
Leo, if I may, there's one thing I like very much about what Florian just explained, and it is, from the entrepreneur's perspective, you could call it passion, right? So deep tech is much more, is much more about passion, about falling in love with technology, and really doing a deep dive and be the best expert on that and so on. And that's something, that's an energy you need as an entrepreneur, because it will take longer, it will be harder, compared to an e-commerce startup or so, even to reach a proof point, for yourself or for investors. But there's also something, I would where I would like to challenge the investment colleagues, because you mentioned product market fit several times, and I believe, product market fit is perfectly right, and you need to figure this out. But one thing jumped to my mind, I was sitting in that developer conference from Nokia, like half a year before the first iPhone launched. And I remember, because I was a frequent user of the Nokia communicator. I mean, the older guys maybe remember that first beautiful device from Nokia, which had internet and keyboard and so on. And there came from the audience this question: are you planning to add touch functionality, to the device, which only had keyboard controls, right? And then the development boss from Nokia who was there said, there's no demand, there's you can perfectly control this device over the keyboard. Our customers love it. We don't think anyone will ever want to control such a device by touching on the screen, and what happened. So my question, and especially with regards to deep tech, is it okay, to ask so strongly, for product market fit when it comes to deep tech startups, or shouldn't we, say, a little bit like Florian said, with the quantum guys, where I guess there was not such a clear product market fit in the beginning, to also look for crazy cool tech that could lead to a product market fit and throw some money on it? Or is that something you find irrational? I'm worried, that we would fund too many of the Nokia kind of businesses, obviously, and not the other company.
Yeah,
I would put it this way: I don't see product market fit as this one singular point in time. So in that sense, I agree, because where is that in time, and when is the market ready to understand the product in your example? What we would like to see, and what is also important once we have invested, to then build with our companies, is some form of momentum or trend line. I think that's maybe, let's call it a metric that I could give away that I want to see, or I want to at least understand how the company, how the team will build that. Because at least here in our European funding system, you need to build some form of momentum or trend line to get to follow-on financing. It's very hard here to just pour in money for a long time without anything becoming visible. So yeah, I'm also not using the product market fit wording that often. For me, it's more, something needs to become visible over time, and it needs to move in the right direction. And that can be, you can achieve that in very different ways. You can build a developer community without selling a product. You can have more pilot project demand from industrial customers, and if you show that, you see people want more of this, and there are many other ways. But you need to at some point start building a momentum or a trend line to get to more financing.
I think for me, it's just to clarify that, what I'm referring to as product market fit is, if you're looking at an early stage deep tech company, the risk is that you're going to be funding science, funding experimentation, and you want a team there. And really what you should be doing is funding an awesome team doing that, right? And I just feel like it's super important for the team to not only be great at developing the technology, but having a clear understanding of where that will fit in the world and where there is a need for that. And of course, that's going to change. But I just have to, for me, I think it's so important to see that skill set within the team, that they can justify, or they can explain or define where their technology is going to fit in the world.
Yeah, thanks for all of you for these very valuable comments and points. I bet, or I hope actually, that the question from the audience was very thoroughly now answered. And I would like to move on to maybe one or two more questions as we are approaching the end of our digital event and live stream. But I want to bring up this question that came up through the YouTube chat by Thomas. Thomas is asking, it seems to me that round size is lower in the EU than US for the same maturity level. Is this still the case? Florian, I'm looking at you.
Yes,
I'm looking at you.
I mean, it's an easy answer. Yes, but it's getting better.
Okay.
Right? I think in every kind of statistics you look at, actually Europe has become very, or not very attractive, but more attractive. Even in the past few months, I have the feeling, right, that American investors are looking to Europe and looking for kind of like the next unicorns here. Because on the other hand, because yes, on the one side the tickets are smaller, but also the valuations are smaller, right? So kind of like in comparison, that makes sense from an investor's point of view. But yes, it is smaller, but we are working on it.
Okay. Any last comments from Hong Kong, Munich, or Stefan, where you are sitting?
Okay.
But I mean, I just wanted to add, it's not stupid European investors who don't get it, because we often get that question. So why didn't you just make the rounds larger? My perspective is, it's the entire system is turning faster in the US. It's turning for longer and it's turning faster, and we're getting there. We're accelerating, but you cannot just change one metrics by the investor just making the rounds larger, right? So the US has had more exits, larger exits, has raised larger funds, has seen better returns, and can write more risky, larger initial tickets. And we will get there as well. But we need to work on this all together, the entire ecosystem.
Perfect. I think
just...
Yeah, last comment?
Sorry,
Duncan?
Just adding to that,
is
like the American investors also have a higher cost base for the typical investments they're making. So they're looking at companies in Silicon Valley. It costs a load more to invest there. I think one interesting outcome of COVID could be that American investors start to be more comfortable with doing things online, and therefore you would see a lot more interest in Europe because the cost base is so much lower for the same talent.
Yeah.
And
So
by the way, last comment from my side, COVID also changed the level or created a more level playing field in terms of, reaching out to customers, so talking to US customer at the moment for us is the same as for our competitor that sits in the valley. It's a Zoom call, right? And the more we keep of that, even if COVID is over, the more the market will be enlarged. Not just for investors coming to Europe, but also for startups going to the US or to the Asian markets, because we don't have to travel to start business with companies over there. That's a big advantage, that we developed over the past 3 months or so, and it gets better and better.
perfect. And getting better and better. I think this future projection of Europe getting there, and potentially ticket sizes getting bigger and investments getting bigger. We hope that all of you young entrepreneurs and founders also in the audience are having good luck and a good way to receiving capital in the future. And with this last point, I want to for the last time address our panelists and give a big thank you for joining the discussion. Florian, thanks a lot.
Sure.
Duncan, thanks a lot. Robert and Stefan, thanks a lot for joining. Very interesting points, and I hope also you in the audience you enjoyed our 1-hour digital event, which there will be more to follow. And if any of the questions still urge you, then make sure to contact Hubraum or HAX, potentially also btov or Stefan from Ubirch via email, and also visit the websites if you are seeking an investment or are interested in an acceleration or incubation program. Make sure to also visit hubraum.com, hax.com, ubirch.com, and btov.com. I think so. Yeah, thanks a lot, and enjoy the rest of your day. Make the most out of it, and see you soon. Thank you.